Hello, everyone. Good morning, good afternoon, and good evening, depending on where you're joining us from. It is great to have you all here for today. As you join in, please do let us know where you're dialing in from. We would love to understand where our audience, which global part of the world our audience is dialing in from. Kindly use the chat box to do let us know the city and the country that you're dialing in from for today's session. Please do let us know from the chat box to better understand where you're dialing in from. We would love to know where our audience is dialing in from for today. Great. We have some good responses coming in. Mumbai, India, perfect. Delhi, okay. As you are joining in, please do let us know from the chat box where you're dialing in from. We would love to understand where our audience is dialing in from for today. Wonderful, wonderful. We have a lot of audience. Oh, Lucknow, we have somebody from Lucknow as well. Perfect. Okay, a lot of folks from Mumbai. Pune. Hello, everyone. Good evening, good afternoon, good morning, depending on where you're dialing in from. Please do let us know in the chat box where you're dialing in from. Perfect. Wonderful. We have people from all corners of the world that are dialing in for today's session. Thank you all for joining in. My name is Jelda De Silva. It is wonderful to have you all here. I represent Seed Global Education, and we are a UK headquartered company where we aim at and we are dedicated towards connecting top universities with aspirants and candidates that are looking for best global opportunities. The theme for today's session is Universal Returns, Rethinking Investment Performance for a Diverse Investor Base, investing in profit, purpose, and people in mind. Our speakers for today is Dr. Chen Wen T. Dr. Wen is the Associate Professor of Quantitative Finance at the Singapore Management University and the Academic Director of its Masters in Quantitative Finance program. He holds a PhD from the University of Cambridge and has worked with Goldman Sachs Hong Kong, Morgan Stanley London, among others. His research explores derivative pricing, research management, risk management, and machine learning in finance, earning him several Teaching Excellence Awards. We also have with us Lynn Orr. Lynn is the Recruitment and Admission Manager for Postgraduation Program at Singapore Management University. She has been with SMU since 2022. Lynn oversees recruitment strategy and admissions, ensuring a diverse and talented students cohort. I welcome you all speakers for today's session. Thank you for joining us for today. A quick introduction of our partner school. Singapore Management University Lee Kuan Yew School of Business is a premium Asian university known for its world-class research and teaching excellence. Founded in 2000, SMU aims to develop creative and entrepreneurial leaders with global impact. The education model is interactive, collaborative, and project-based, preparing students for the modern economy. Before we get into the main theme for today's webinar, I would like to launch my first questions to better understand what is that our audience is majorly interested in. The first poll question on your screens. Do let us know, when evaluating an investment, what are the factors that you think should be mattering the most? Is it profitability? Is it sustainability? Or is it long-term resilience or investor diversity and inclusion? The poll question will be live for another 20 seconds. Please do add in your response for the same. Perfect. We have some really close competition between profitability and long-term resilience. Thank you, audience. The poll question is now closed. I am sharing the results with you. A good amount of our audience wants to understand, 38% of you want to understand the profitability element of it, closely followed by long-term resilience. Thanks a lot, audience, for participating for this poll question. Over to you, Professor Wei.
Hello, good day to everyone. Thank you, Seed Global, for giving us this platform to communicate with all of you. So it's a timely survey. I think it is interesting that I can see that most of you are interested in profitability and also sustainable return over the longer term. That is indeed the primary concern for all investors when they are considering their option, right? And that is also nicely aligned with the topic that I've chosen today, which is about universal return. So it's just a terminology, but the idea here is that we want the performance that you report to your investor to be as universally applicable as possible, rather than only relevant for just a few privileged investors. So the subtitle, therefore, is Rethinking Performance for the Entire Investor Community. Okay. Now, before I move on, right, so I just want to say that this is an interesting idea. I personally find it very elegant, but also it is a very simple idea at the same time. So yeah, during the talk, if at any point in time you were thinking to yourself, is this guy or is this prof really talking about something so simple, or am I just missing anything? Let me just reassure you that you are not missing anything. It is really a very simple concept, okay? So simple is simple, but it doesn't take away the usefulness of this concept, right? So for those of you who have already looked at the synopsis, I think here is just to start off with one question. Suppose now you have just graduated and you have just earned your first pot of gold. You are now ready to invest in two funds in here that are available for you to choose from. Now, Fund A is the one that is blue in color, so that is the upper one. And then Fund B is the black color one, which is a bit lower. Now, given a choice, which one would be your choice of fund? So just give it the first idea that comes to mind, right? It is not a trick question. It is actually just a personal opinion thing, right? So it's a survey for us to understand your opinion a bit better, and it is not meant to be a trick question to trap people in choosing the wrong thing. So there's no right or wrong choices. Maybe we give it another 5 to 10 more seconds before we take a look at the survey so far. Okay, so now we have 80% on Fund A and 20% on Fund B. Okay, now it is the obvious choice, right? For Fund A, if you look at Fund A, it is the one that has the highest return over time. But for the minority, for the 1/5 of you who have chosen Fund B, would you mind just typing, one or two short phrases to explain why did you choose Fund B? In the chat box, if you just, and anyone can just write one or two short sentences. No? Okay, it's fine, okay? So it's not meant to be a trick question. Yeah, Fund A is going up, so steady, it is more consistent, longer term performance. Okay, yeah, that's good. I think that is primarily the main concern that we should all be thinking about, right? When we are going around selecting the best investment option. So with that in mind, right, just put this choice and also these two options within your mind. Let me just go through a little bit about the research outcome of this study, and then how does it tie back to what is the best way for us to go about choosing between Fund A and B. Okay, now I told you, right, it is going to be it's not a complicated concept, but I do find it very elegant in many ways. So the backstory is this, right? Quite a few years ago, I was reading this journal that was this Journal of Finance that published this particular paper called Volatility Managed Portfolios. Okay? So that was about 5 years ago, and that triggered me to think about how do we think about investment return? Because if you look at this, right, Journal of Finance is one of the top-rated journals within the finance discipline, and this is a very well-regarded paper, right? You can see that on the top. So I think this is an important thing. It says that if you were to follow volatility managed portfolio strategy, okay, you can take less risk when the vol is high, and that gives you higher returns, okay, higher alpha. So what it means is this, right? When the market is very volatile, take a bit less risk, put more to the bonds market and put less to the equity market. When the market is not risky, put more or allocate more to the stock market. That's it. So it is a really simple concept to take risk when risk is cheap, and then not to take risk otherwise. Now, and then after that, in the paper, they gave us this following figure below as the performance. All right. So for academic, you'll see that for our in studies, the research is always very long term. So it started in the year, look at here, it is 1926 is the starting point, right? And then do the back test all the way until 2020, which is just a few years back. And here they are comparing between two different investment strategy, right? The first one is called buy and hold, which means you just buy the market and hold it for the long term, right? So just buy the market and do nothing and then hold it for, in this case, it is almost holding that for the whole century. And the second one, which is their suggested or advocated strategy, which is called vol manage. So this is the one that they mentioned in the abstract on top, right? So when the market is risky, take less risk. When the market is not risky, take more risk. So scale your exposure in proportion to the risk existing in the market. And clearly, in their view, this is the better idea, right? It gives you the outperformance, all right? Now, so this is, again, is similar to the choice A and B that you have seen above. But if you were to look at this graph, right, did you notice something that doesn't really gel when they are claiming that this vol managed portfolio is the one that gives you significant outperformance? If you just look at the graph, right, is anything that comes to mind about the lighter color one doesn't necessarily really outperform in the sense that we are saying that it outperforms for sure, right? It is always the better choice. You can type your opinion in the chat box, but one thing that I immediately sort of noticed is that starting in 1926 is maybe not very fair, because that is exactly when the Great Depression was meant to start, right? In 1926 to 29, and then after that we have the onset of the Great Depression, and the stock market was meant to decay for a long time, extended period. So just before the Great Depression, you introduce a strategy that say take less risk when the market is tanking. That kind of have some sense of a look back bias, in my opinion. So that's why you see, right, immediately this black color line is falling, because if you just buy the equity market, you will suffer the losses, right? But if you were to scale back your investment, then of course your loss is less pronounced than otherwise. But notice the difference between these two, right? So the gap is about this distance, and you look at the gap that is around 2020. Isn't that almost the same gap, right? So this difference in performance return is almost the same as this difference in the performance return, right? If you look at this graph, you could almost say that, after 1960, these two performance are actually virtually identical. There's no difference between any two of them. You buy any one of them, you get the same return. Most of the outperformance come from the early period where you avoided the Great Depression, and then you also avoided a few events around here in the mid-50s where there was some oil crisis, right? So that was the case that makes the vol managed portfolio perform better. So that prompted me to start thinking, maybe there is this kind of performance graph is what we are very familiar with, right? You are given any when you're presented with any investment opportunity, this is the graph that is going to be presented to you. Maybe the graph doesn't really tell the whole story. What is the best way for us to present visually a performance that everyone can look at that and then understand how relevant is this to me? Okay, so that is the initial thing that prompted my research question. So let me just unpack this a little bit further. Okay, so this is exactly the same thing, right? So the blue color one is the vol managed market, the vol managed portfolio, and the orange color one is the entire buy and hold the whole market. And here I just try to break it down into 3 periods, right? So you see from 1929 or 1926 actually to 1965, clearly the blue color one, the vol managed portfolio performs better, right? You can see the outperformance gradually expanding over time. So that's for sure, right? If you were to invest before 1965, the blue color one, vol timing is actually a lot better, right? Now, next, if I were to add in the next 30 years, right? So from 1965 to 1995, now if you look at these two, right, you can almost start to see that maybe the blue color one isn't really so good anymore. Notice that at the end of the 1995, this is the distance between the two performance wealth, whereas in the starting point, they were actually a bit wider, right? So you can see that here, it is wider, and the difference between the two started to contract over time. And then even more, if I were to move all the way back to today, then you can see that it either performs exactly the same, or there is some further contraction between the distance between the blue color and the orange color line. So you could almost say that the blue color one outperforms the orange color one because of the first 40 years. And all the outperformance happens in the first 40 years. After that, they are either virtually the same performance, or actually the orange color one could be performing better. Okay, now from the graph, it is actually quite difficult to work out, right? Because whenever you plot a graph like this, you always fix your reference point at the initial starting point, right? So here and here and here, that is how the graph is being plotted. That is the starting point, and everyone's performance is measured from that starting point, from that perspective. Okay, so that's what I'm trying to answer this question. That this is maybe not the best way to look at return, right? So whenever you are investing, you're always given this kind of a conventional performance graph, right? Either it is a cumulative return, so just sum over the log return or compound over the geometric return, or you are given something called the P&L curve or the NAV curve, the net asset value curve. Sometimes we call it the equity curve. Well, slightly different name, but more or less they all mean the same thing, right? Fix an anchor point at the start of the investment period, and then just draw the performance of your investment return over time. Okay, now there is a big problem with this thing, okay, which is that graph is actually plotted from only one person's perspective, right? Which person? Well, the investor who invested since the fund's inception, right? I started here in 1926, and then I plot all the graph using 1926 as the starting point. So it is all drawn from my perspective as the first person to invest in the fund. And the first person to invest in the fund is usually the fund manager himself or herself, right? So you started the fund yourself, you invest in it, and then you draw the graph according to what you have experienced, not with respect to your customers who actually came into the fund at a later date, right? So that is the problem. So the reality is that you are not supposed to show what is performing well for the initial investors, but rather you are trying to show a graph that everyone can look at it, right? So whether I come in 1926 or I come in 1965 or 1995, whichever day I come in, I should be able to look at the graph and then see for myself what is the return I have experienced over this period of time. So then this graph is now more relevant for a much wider investor pool, right? Not just the first person to come in, but every single person who are in this fund, no matter when they come in, this graph tells them something valuable. Okay, so that is what we are trying to address, right? Most of the investors did not invest in the starting point, right? Most of us didn't buy Bitcoin in 2009 because it was only worth a few cents back then, right? So none of us were there. So if you were to show me a graph that says Bitcoin went from a few cents all the way to whatever $30,000, $100,000 it is worth today, then that graph has no meaning to me. I wasn't there so early on, and neither were you, right? Neither were most of us. So the most relevant question is to try to give people the feel of the actual performance return they are actually experiencing. So that is the concept of universal return, right? By universal, we mean that we want this performance graph to be applicable to everyone, right? No matter when they come in. And actually, it sounds quite fanciful, but actually it is a really simple concept. Now, the problem with cumulative return, so which is the conventional one, is this. You set your anchor at the initial date. That's why you just keep on summing up, right? So from 1 all the way until today, you look at the performance return over time. Now that is the problem. The correct way to set the anchor should be today, right? So this is here, this is the solution. You should start the anchoring at today and start to add up your return backward in time towards the past. If you were to do it this way, then it makes it a lot clearer. If I came into this investment option at different point in time, what is the actual return am I experiencing? So mathematically, it is almost trivial. It is just a reversing of the order. Rather than summing up from the starting date, you sum up from today backward in time to different entry point of your investment vehicle. Okay. Now, let me show you the same three graph again, right? So the top graph is the one that you have just seen earlier. So the well-managed portfolio given to us by the Journal of Finance top researcher, and then they claim that this is the one that can give you top performance over more than a century. Okay, so you can see this is exactly the same figure as you have seen before, the top one. The one below, as we say, that this is what we call universal return. So if you look at this point, right? Suppose I want to look at my universal return at 1965. So I start at 1965 and I start to add my investment return backward in time. And I get these two curves, right? The blue color one and the orange color one. Same as the one above, right? Whatever graph is on top, that is the outperforming one. Whatever graph is below, that is the underperforming one. And here it is very clear that the blue color one is consistently above the orange color curve. So that means that no matter when you come into these two options, before 1969, it is always better to buy the well-managed portfolio because it is consistently outperforming, not just for the initial investor, but for all the investors who came in at different point in time. But if I add in the next period over here, can you see that they are now more or less overlapping, right? So around this period, they are more or less the same curve. And for here, it is not that much different anymore. And that gives us the next problem, right? If you were to come into these two investment options between 1965 and 1995, whichever you invest, the difference is very minuscule. It doesn't really make much of a difference, okay? Now, if you were to add in the final period, you see, now we can look back from this period backward in time, you can see that actually, if you were to come in after 1965, the market is the better investment option, right? So the blue color line is only above the orange color one in the first period, right? From the first 30 to 40 years. And after that, the orange color one is actually arguably on top. So this gives you the clear idea that for those investors who come in, right, this strategy has already stopped working for the past 50 years already, right? It hasn't been working for the past 50 years, and you cannot be fooled by this graph on the top. So if you only look at what the prospector tells you, it seems like the blue color one is still outperforming. But if you just take the reverse or the alternative point of view, it becomes very clear that, well, this is no longer true, right? I think that change of perspective from now to look backward in time, I think that is the main approach that we should be taking. Because in this case, now every person who come into this investment at different point in time, suppose the person come in at this point in time, the person can just directly read off from this graph and say that, oh, I come in here, so my return is going to be this number in here, right? 4.7. Whereas if you were to look at this cumulative return graph, then you have to actually visually calculate from here to here, what is the return, and from here to here, what is the return, and then take the difference between the two. That is just not something that any investor want to do, right? Here we are only comparing two. Imagine if you have an option of 10 investment options, then it will just make the whole work not worth the effort, right? So this is a change of perspective. It makes the whole approach a lot more elegant. Okay? So back to the initial question, right? So this was the survey question. So I was asking you guys to pick between two options. One of them is invest in Berkshire stocks, okay? Berkshire Hathaway, right? Warren Buffett stocks. And then the second one is the S&P index, okay? You were given this graph below, and this graph is plotted in terms of wealth level. Now, wealth level follows geometric compounding, right? Because if you return 10%, it is geometrically compounded. So there is this non-linearity that makes the graph even more difficult to visually analyze, right? You will just clearly see that the purple one clearly outperforms the teal color one. So Berkshire definitely is better. Now, top figure, still conventional cumulative return, but now we are plotting it in log return scales. Once you have taken a log, now it becomes a linear problem, and it becomes at least more detectable that this one in here, right? You can see that these two graphs are almost identical, just difference by the level. So that means that most of the outperformance happens earlier in time. And after that, actually, S&P and Berkshire Hathaway stocks, performance has been more or less the same. And that is something that we have been reading some occasionally in financial news, right? And now this is very clear if you were to take a look at the cumulative return, right? So, sorry, the universal return. Whether you use the log scale or whether you use the wealth level, you can see that it makes no difference, right? It is very clear that after this initial period, okay, the two lines are virtually overlapping with one another. Now, overlapping line means equal performance, right? You have to be higher for it to mean that the performance is better. So this graph makes it significantly clearer, that it's a lot easier to read, that you can see that this outperformance has already started to decay over time, over the most recent 2 decades, which is not immediately clear if you were to take a look at this most conventional way to present this information. Okay. Yeah, so that's it, right? So that's the idea, right? So what we have said so far is that it is important to take everybody's point of view, not just the lucky person who invested on day one. Everybody who came in at different point in time, their performance, the performance that they have experienced is also important. So you can't take that away. So it is actually more useful to show the return, but if you want to quantify return, right? You want to show the average investor's return. This is the way to show it, right? Using universal return to look at the average performance experienced by all the investors who came into these options at different point in time, rather than just to show the product return, which is the traditional way, right? The product is always starting on inception date, and then you just sum up all the returns over time. So that is just taking the point of view of one person at the start of it. But average investor return means you average across everybody's experience, okay, and gives you a more universal point of view. So that's it, right? So that is how we think about return. Now, once we have this perspective, we can actually generalize and say, can we also say something about risk, right? So we have updated the better way to look at return. What can we say about risk? Now, all of you who have done finance before, you would know that traditionally, the way we define risk is to calculate the volatility of return, right? Like we calculate the standard deviation of a periodic return. So maybe it could be 1 day, it could be 1 month, it could be annual, but whichever. Pick a period, calculate standard deviation of this periodic return time series, and then report this as the vol or uncertainty. Then again, it's actually not really representative, right? Just quoting Warren Buffett and Charlie Munger in here, right? So for them, they have explicitly stated that for us, we don't consider fluctuation over periodic as risk. For us, that is not risk. Risk is only when you have the probability of permanent capital loss is heightened. That is risky, right? So losing your capital forever is risky. Fluctuation up and down over a few days or over a few months, that is not risk at all. Okay, so that is their point of view. Now, turns out that we can conveniently apply the concept of universal return to quantify risk or define risk in this way as well. If we have average investor return, we can also say what is the dispersion among the performance experienced by all the investors who invested at different point in time, right? So not just the one who invested initially, but those who came in 1 year later, 2 years later, on the midway point, or who have only just came in last month. Now, across all of them, everyone experienced different performance. Now, what is the dispersion or deviation of their aggregate experience return? That is risk, right? Because this number actually tells you how uncertain the return that is reported to you is, right? If I tell you return is 10% per year, but most of the investors didn't see 10%, the fluctuation will be large, and that will show up in this performance dispersion metric in here. Okay? So that is the definition. Okay? Now, with that in mind, right, if you look at here, right, so this is still the same managed portfolio performance over time. And below here, I'm drawing two graphs. The first one is what we call reported return, which is the standardized rolling window cumulative average return of the product. And you can see the blue color line, which is very stable. If you were calculating the average investor's return, you can see that it is significantly noisier, right? It is hovering around the same blue color region, but it is significantly noisier because different investors come in at different point in time. So the return they experience will be different. And that is going to be captured by this average investor return matrix in here. Okay? So it means that common metric that we use to report return is actually underestimating the uncertainty of the return fluctuation experienced by the wider investor pool. And similarly, if you look at the final figure below, reported risk versus the dispersion measure we defined earlier. Now, reported risk, you can see that first of all, it overestimates the risk in the magnitude level, right? So it is always the purple color line is always above the green color line. Why? Because reported risk is calculating monthly standard deviation of return, right? Every month, the return fluctuates a bit, you count it as risk. Now, that is short-term jitter. Right? Warren Buffett say this is not risk, it is just a jitter. So the right way to look at it is different investors, how much do they experience, how much their experience is different from the actual performance that is reported by the fund. And that gives you the green color line below. So it is not as high as counting jitters, but it is also more jittery over time, right? Similar to the orange color, the red color line on top in here, you can see that the green color one has significantly more uncertainty over time, right? So that is it kind of shows that we are overestimating the stability of the return reported, and we are underestimating the uncertainty in the return reported if you were to follow just the conventional view. Now here I'm just going to show you a few examples, and then my talk will be over. Okay, so what I've done is this, right? So now we have two return measure, right? One is the conventional one, just calculate cumulative return from the initial investor point of view. And then now we have a new one, which we call universal return, which gives us the way to compare the average return experienced by all the investors who invested at different point in time. So I'm going to call the difference between these two the investor return dispersion. Okay. And sorry, I'm going to call it this thing below, right? The average investor return minus the reported return. Okay, so that is going to be on the x-axis. And on the y-axis is the dispersion experienced by the investor. So if you report a certain return to the investors, now all of them see different things. They are not seeing the number you reported. Then that count as high dispersion. So then it will give you a higher y value in here. So it's just a scatter plot. But here I've selected four particular sample that we can go through one by one. So the first one is A, high dispersion, but very different average investor return versus reported return. Okay, so that is A. Now, what is A? A is this one. It lasted from 2004 to 2008, which is essentially the global financial crisis. Okay, now if you calculate the reported return, which is this dotted line in here, that means that you are going to experience this crash over a period of 5 years. Okay, now it is a crash, so it is painful, but if you normalize it over 5 years, the overall number, you can see it in here, is actually not that negative, right? But that means that you have to be there 5 years ago. Most of us aren't. We might have invested at different point in time within this 5-year period, right? The credit market was booming and we all wanted a piece of it. We started to come in. Those people who came in around this point in time, they will experience a severe drop over a period of 6 months to maybe up to 1 year the most. These people experience significant loss over a short period of time. These longer-term investors experience a moderate loss over an extended period of time. The dispersion is high. Their experience are very different, and this is where it makes a difference. Okay? Now, maybe I'll not go through every single examples in here, but let's take a look at I think I'll take a look at D, which is another interesting example in my perspective. Right? So if you look at D in here, which is this one, which corresponds to this, right? So it is 2018 to 2023. So here was COVID crash. Now, after COVID crash, lots of easing policy came in. There was a market rebound. And then when at the end of it, when the news about rate hiking starts to come in, then the market tank again. Now, a moderate drop, severe rise, and then severe drop. This is, again, you have a high dispersion, right? So there's a lot of difference. Investor experience very different return compared to the 5-year return reported. okay? But the average return is also very different because why? If you come in here, right, it's actually good for you, right? You see, you get a moderate gain. If you come in here, you experience a severe loss. So that's a huge difference among the investors of the losses or performance they are experiencing. But for longer term investor, they came in here, they exited here. So that is virtually the same point. For them, they didn't see any difference in the market. They just, they ride the boom and then they also ride through the bust. So there's no, they get zero return overall. Now these are the interesting time when it matters, right? When the reported return and the average return is deviating away, this is when things are interesting and you need to take a more universal view to make sure that you are not missing out on the important information. Now, I'm not gonna bore you with this one, but just to say that I've done a lot of these kind of simulation studies to say that if all the investors who came in at different point in time, right? So all the short-term investors, mid-term investor, long-term, and all the overall investor, they came in at different point in time, and we try to study the correlation among their experience with respect to if a fund choose to report a 1-year average return, a 5-year average return, the 10-year average return, or the new concept here, the universal return. Notice that this is the one that is consistently the highest. It is always the most applicable to all the investor pool, no matter whether you are short-term or mid-term or long-term or overall. This is the one that has the highest correlation with your actual experience performance. Okay, so I think that is essentially the idea. Okay, so that kind of brings me back to my conclusion here. I think so. This one maybe I'll just skip this one because it is essentially just like rehashing what I've just been mentioning to you. Right? We need to take a democratic point of view to make sure that every single investors are receiving useful information when you're presenting this performance report to them. Okay? So that is, I think that this will be the key takeaway. Okay. Now, when you are considering investment next, first ask for your story, right? The fund prospectus is not going to tell you, but you are able to access those information because as long as the fund give you their cumulative return information, converting from cumulative return to universal return is just a simple matter of doing your summation in the reverse order, right? So once you get the data, you can handle it yourself to get converted to something that is more meaningful to you. And that allows you to take on a more democratic point of view to measure investors' return, right? It is the average investor return that is important, not the first few who invested way back in time. And also risk is horizon dependent. For a short-term investor who always buy and sell every month, maybe the standard deviation of monthly return is important. But for long-term investors, I don't care what is the monthly return, the standard deviation. Right? I look at it from the long term, unless there is a permanent capital loss opportunity. Otherwise, I'm not going to consider those things as risk. Right? So next time when you see any fund report, just ask it, right? Is it something that is applicable to me? And also how much deviation or fluctuation can I expect all the investors who bought the fund at different point in time to have their experience, right, different from the one you're actually reporting in your investment prospectus. Right? So this will be the main takeaway. And just my last slide in here. So this is just my final slide. And I just want to part with this one final closing remark, right? Which is about back to quant finance. Now, this is a piece of quant finance research, right? But anytime you mention quant finance, right, for most people, once they hear the word quant, they either think that there is something about very advanced stochastic modeling, or there's going to be some reinforcement learning, some deep convoluted neural networks, some latest AI models. All these black box models immediately comes to mind. But actually, quant finance is not really about that. These are the tools available to us. But actually, those who are successful, all the successful quant, you find that they are always, they are good because they are asking deep and relevant question about the market. Right? So asking the right question is the defining quality to identify who is the better quant. Right? It's about asking the right question. because you can also ask ChatGPT the question. So answering question, coming up with complex solution, that is not the way how a good quant will function. The good quant asks a deep question and try to find the simplest, most stable tools available to answer those questions. Right? And here I think I'm hoping to use this universal return as one example. Mathematically, it is simple, it is almost trivial, but the idea that it convey and also the general information it can pack into just one simple graph is just so much more, right? So much more meaningful to look at these data in this way than to look at it from a more traditional, conventional point of view of everyone just follow what the initial investors experience and use that as the benchmark. So that's all for my talk. Okay, so I think this is the main takeaway, is to take universal point of view whenever you are considering your investment option next time.
Got it. Thank you, Professor Wen, for sharing these wonderful insights with us. That was truly interesting and informative. Before we move ahead and introduce our second speaker for today, I would like to launch our second poll question to better understand what our audience is majorly excited about. Your poll question on your screens right now. Do help us understand what motivates you the most about pursuing a career in finance. Is it finance or investment management? We will keep the poll open for another 20 seconds, requesting our audience to please add in your preferred option. Higher financial growth potential is currently trending, guys. Alongside global career opportunities. Perfect. Thank you all for sharing in your preference. So a good amount of you are looking forward to higher financial growth potential, closely followed by global career opportunities. Thank you all for participating in this poll. Now, let us move on to our next speaker. We have Lynn Orr with us, who's going to share more information about admission process, international opportunities, and how SMU is supporting students through its global education journey. Over to you, Lynn.
Thanks, Gelda. Hello, everybody. Thank you for joining me and Prof T this evening for this masterclass as well as this information session. Allow me to share my screen and then I'll walk you through the programs here in SMU as well as the options that you can consider if you are considering a finance career in future. So a little bit about Singapore Management University. We are a relatively young university. Right, established in year 2000, like what Gelda has shared. I think as a young university, we are actually achieving quite a lot. And Lee Kong Chian School of Business, which is the school that I'm representing, is the flagship school of SMU and the largest business school in Singapore. So ever since we have started, and also ever since we have our first batch of graduates, we have actually saw a very good employment record and build a vast business network across 3,000 over business connection in Singapore and the rest of the world. So a little bit of fun fact, if you're talking about internship in Singapore, I think SMU is the first university that actually implement mandatory internship to university students when they are completing the program. So I think if you are considering about a career, choose a university that actually helps you in terms of your career, in terms of what they're good at, and spend some time to understand how Singapore Management University really stands out. So, which brings me to my next point, where the university is actually located, and that is very helpful in terms of your learning in Singapore. First thing first, Singapore Management University, if you have never been to Singapore, we are actually located in the city center, the CBD area. So if we are talking about financial centers, if we are talking about the bustling business district, you can see that it is all around the business school. So at the top, you have the business center, very distinct shopping areas, Orchard Road, and then down south, you actually see Marina Bay, which is where our financial center sits, as well as our Singapore Flyer, the Marina Bay Sands, and a lot of other museums. So this gives you a competitive edge to really learn about how businesses are like. And if you are intending to take on an internship while doing a program, you have the advantage to go for interviews, to go for internship while you're in the program. So very welcome to the Lee Kong Chian School of Business is the picture over here. Like what I've said, I think as a young university, we have earned quite a bit. So we have what we call the Triple Crown accreditation, which is awarded by AACSB and by NAQUIS. These are accreditation body that has studied that have given us that testament that the quality of teaching is superb, and it's something that you can look for when you're considering business school, because most of the renowned business school like London Business School, like Wharton Business School, they have very good accreditation, which justify that the standard of teaching are very good. Something for you to take note as well is that our finance program, MAF program, has earned second placing in Asia this year and 33rd globally in the QS 2026 ranking. So we have climbed quite a bit since last year. If we are looking at this recognition last year, we were standing at third in Asia and 41st globally. So I think this really gives a lot of testament to our quality of teaching, and it's something that you can consider when you're considering a master's in finance. So how are we different from all the other universities that you are going to research or you are currently researching? I think it's our classroom experience. We modeled quite closely after the Wharton Business School from University of Pennsylvania. So they encourage a lot of interaction, a lot of soft skills, a lot of action-based learning. So you can apply what you have learned in class. And something unique about the school is that you are required to participate in class, like how you have participated in the polls. This actually enhances your learning. It makes you think on the spot. It lets you ask questions while the professor is teaching the concept, and it allows the professor to have more meaningful interaction with the students. So with that, you actually could retain some of the information a lot more and apply in your workplace in future. Right, so there are also a lot of presentation, a lot of group work. It enhances your teamwork abilities as well as communication and leadership. Here in Singapore Management University, I also think that we are very good at our Asian case studies that you can refer to on top of the global curriculum that we have. So if we are looking at having a career in Asia, be it Singapore, be it back in India, or be it the rest of the world, you can actually have the knowledge and apply what you have learned into use because you have studied so many different case studies that is in Asia, that is global, and I think those are very useful. So last but not least, I think in SMU you have great faculty and mentors like Prof. T. I think he is one of my favorite professor when it comes to masterclass. He gives a very comprehensive teaching, and he's one of the most patient professor in my opinion. And I think that whatever concept that he teach, you will be able to clarify with him afterwards as well. Our professors, they come with years of experiences. It allows you to really connect and clarify if you are in need. And also some of our faculties, they are adjunct faculties, which means that they are currently a practitioner in the industry. Whatever you learn in class is not only practiced in textbook, they are also practiced in the industry. So those are very meaningful experience that I think if you're not in class, you will not be able to get it. So this is something very unique to SMU, and I think this is how our alumni really shared that they have benefited from SMU as compared to other universities. Right, so I mentioned that we have two programs that I'm going to share. One is the applied finance and one is the quantitative finance. These two programs are similar and a little bit different. I will just go into a brief introduction. If you need more information, feel free to connect with me afterwards and I'll point out like big difference of these two programs to you. So applied finance, if you compare the core modules as well as elective, you see very similar concept of what you will be learning. If you are going to prepare for things like CFA, which is Chartered Financial Analyst certification. So with relevant industry partner, I think most of our graduates, after they have done their MAR program, they are able to land into jobs that is finance related and apply what they have learned into use at work. So if you are unsure of what kind of finance you want to take, I would say that considering the applied finance, it will be a good step board for you to venture into a career in finance. And there are elective specialization that you can consider if you are in the program. So something very special, I think, about the MAR program is that we also have a very practical approach. For example, our portfolio management over here, students actually get to manage real money while they are doing this module. So I don't think that there's a lot of opportunity you get to portfolio manage in school. This is one of our highlights in this program. So going into the quantitative finance, I think it's a little bit different to applied finance. Quantitative finance is also taught by, it is also like quite similar to the concept that we have shared through the masterclass. We ask questions and we ask relevant questions to understand the market. And you will see that the core module has a lot more technical modules, such as stochastic modeling, such as derivative, such as risk analysis. So there are also a little bit of programming modules. So that also means that students who are taking the MQF program, you would need to expect that there are certain level of programming in this module, as well as you need to be comfortable with doing mathematics questions, because when you're looking at, for example, graphs, or you are understanding how you are putting in information into the computer, you need to understand a little bit of this language to input the knowledge. We have two tracks. One is the SMU track, one is the international track. If you are interested in just studying in SMU, I think this would be the perfect track. But if you want a more global experience, the international track actually allows you to go to Bayes Business School for one term, one exchange term, and once you have completed this international track, you will be graduating with degree, the master's degree jointly awarded by the SMU as well as the Bayes Business School. So it's quite interesting because your graduation certificate, there will be two logos instead of one. Similarly, there are specialization track that you can choose from. And I think all these tracks are very interesting. If you want more time, feel free to reach out to me after this session and I'll share the elective specialization differences to you. So a snapshot of what is the difference between MAF and MQF. I would say that if you're looking at a career that is more quantitative in nature, you can consider quantitative finance. But if you want to have an application use of finance knowledge and learn about more products, you can consider the MAF program instead. So the duration of these two programs are quite similar. Both are 18 months, which is 12 months of studying and approximately up to 6 months of internship. We only have August intake every year. So the application is already open and we will close our application on 31st May for both of the program. So there are definitely internship opportunity and specialization track that you can choose from. both of the program, we have partnered with industry partners. So take your time to understand what industry partner we partner with, because it's very relevant to the kind of job that you're looking for after taking the program. So I would pause here for like 5 to 10 seconds for individuals who want to take a snapshot, or if you have more questions, you can pen it down and put it in the Q&A later. So these are our faculty. I will also encourage you to take a snapshot, because these faculties, I think they really come with a lot of experience. If you have time, also go through their research papers. I think some of their research are really very interesting to read. Career, look for me after the information session. I will be happy to share this slide with you as well. And I would like to take the opportunity to share that we have actually a very good team of career coaches. They are people who really takes care of you when you're in the program, be it giving you career advising, planning for career development series, and also help you reach out to the employers to create events such as industry and career talks, as well as networking fair, so that you have enough resource to reach out to if you are considering a career in Singapore. So if let's say you are intending to do your internship in Singapore as well, these are the people that you need to talk to in order to help you with your interview, be it an opportunity, or what are some of the tips that we can give you that will be very helpful. These are some of our alumni that I think have graduated from this program. And last but not least, I think a lot of you are interested to find out about the admissions requirement. Just go through it quickly. After you have completed your bachelor's degree and you want to apply for a master's program, you need to prepare a resume. 2 short essay, more like personal statement or statement of purpose, telling us why you want to apply to this program, as well as a little bit about yourself. And 2 referees, you just need to provide us with your referee contact, and we will reach out to them with an online referee report. If you have GMAT or GRE already, that's great. A GMAT focus edition, we are looking at a score of 595 and above, as well as GRE of 312 and above. If you do not have these 2 test scores, feel free to still put in your application, because after you have put in your application, we will administrate the SMU admissions test to you instead. For Indian students, I think all of you have learned your undergraduate studies in English language. Hence, a TOEFL or IELTS will not be necessary for you. And if you have a CFA, ACCA, or any certificate that's related to finance or accounting, feel free to submit them as well. Last but not least, I think a lot of people are interested about the finance or the costs of the tuition fee of these 2 programs. If you are applying for the program, I will be happy to extend application fee waiver. I will get in touch with Jalda as well as Seed Education later to get your emails to send this to you. And then we do have, if let's say you don't have the GMAT or GRE, SMU admissions test costs about 125 Singaporean dollars per attempt. And upon successful application, you'll need to take note that there will be registration fees of $500, as well as the full tuition fee of the 2 programs, MQF, 59,950, as well as the applied finance, 63,220. Of course, we do have scholarship, and I'm very happy to share with you about scholarship if you have more questions about it. And I would like to take this time to answer some of the questions that you may have. And yeah, Jalda, back to you.
Yes, thank you, Lynn, for taking us through the admission and application process and helping our audience better understand what are the steps that one should take in order to start their degree journey with SMU. Audience, please note that we will now be taking the questions that you have asked to our speakers. If you have any questions that you want to ask to our speakers right now, please make sure that you're adding it in the Q&A section. I know we are a little pressed on time. Speakers, I would like to request you, can we extend the webinar or the masterclass for another 10 more minutes?
Yep.
No
Perfect.
problem.
Thank you. With your permission, we go ahead. I have a few questions that have come across around the theme for today's webinar. So I'm going to ask those questions to Professor Wen. Professor, the first question is, if volatile managed profiles show higher Sharpe ratio than buying and holding on, how does tax, trade cost, and long-term risk affect these advantages? This is a
Sure.
question that multiple of our students have asked.
Got it, got it. So even if you were to buy the market, right, it seems like you are just doing it passively, but actually buying the market also involve constant readjustment because the market capitalization will change all the time. And based on that, every month, there'll still be a readjustment of your exposure to make sure that you're always holding on to the market. So virtually all the two strategy actually have more or less similar transaction amount involved. So there's no difference in the transaction cost in between these two. So the graph, the well plot that is being shown in there has more or less already factored in whatever market impact that might be involved and ended up looking like that. So I think that part is already being taken away and considered in terms of all the taxes and transaction costs.
Professor, our next question is again to you. This is about understanding the psychological side of this. Why do investors often feel that the real returns don't really match what they see in the report? What are the elements or factors that that psychology has influenced in terms of these interpretations?
I think, yeah, that's actually a very good question. I think behavioral and psychological aspect of this is something that hasn't been studied well enough, but that is definitely all of us have this experience, right? The example I used just now was that people keep on telling us, if you were to buy Bitcoin 10 years ago, this will be your wealth now. But no one is going to do that, right? So if in 2009, only a fool or a pure gambler will put all their wealth into Bitcoin because it was still such an early stage and it was purely speculative. For finance, we have to accept that most of the things we see in the market are extremely noisy. So it makes sense to allocate a little bit of your wealth into Bitcoin if you're into it, but not everything. And if your allocation is little, it is not going to it's not going to change our life. It is only going to give you a small diversification benefit and earn you a little bit of money. So that is true, right? That is something that we all experience all the time. And that's what also makes many investors start to doubt the experts, and then they want to do their own studies. I think this attempt is also one way that we can try to be, once you are more universal, then people are more receptive to your report because they see that you are trying to convey information to them and see things from their perspective.
Got it. Our next question, which is a very common question, and it's to Lynn. If you had to, create a checklist for an ideal profile that, SMU would consider, what are the key elements that a candidate should consider when creating their application for SMU?
I think to us the statement of purpose or the essay is very important. It tells us your career aspiration and it also help us to get to know you better. If you have internship experience in finance, I think those would be helpful as well. But if you do not have any experience in business or finance and you are considering repivot your career to finance, I think both of our MEF and QF program do accept students with no backgrounds. During the interview, you need to highlight why you are a deserving candidate for this program, and we will assess accordingly. Else, I think all the information are online, and the admissions requirements are strictly what we follow through.
Got it. Our next question is around, global degrees. Whenever a candidate is considering a global degree, one of the concern point lies in how is the campus life going to be. What are the various key factors or opportunities that SMU has present in order to make student-to-student connections more relevant to our applicants? And also, if in case there are any kind of student mentoring or alumni mentoring options or projects that you have available. Could you share a little bit about that?
Most certainly. So we see student life in a few different aspects. First thing first, in school, how are you going to connect with your peers? I think the classroom setting allows students to have an interactive engagement. So that is the first point of contact, your classmates. Two, there are mentors and also career service to guide you through the professional developments. Our mentors are always coming back to give some insights to students, graduated alumni, on how they can navigate through the career, what are some of the things to take note. And then three, after classes, if let's say they are interested in clubs, society, student life, very happy to share that there are actually quite a bit of student clubs that they can be considered for. But also take note that our curriculum is quite heavy, manage our time carefully. Lastly, I think when it comes to networking, we also have career support that will introduce things like career fairs, networking fairs to help them build professional networks with the industry.
Lynn, the next question is again a follow-up of the same one. You did speak about the internship opportunities that are available when a student is pursuing a degree with SMU. Can you also help us understand what are the project-based options that the students have available to make the content much more relevant to the industry? And what is the role of the faculty or mentors that play in these projects?
Actually, I think Prof T, he can be a better person to share about how class, how practical approach can be useful for students. Prof T, do you catch the question?
Yeah, sure. So I think for us, right, because many of the faculty have industry experience, and many even for full-time SMU faculty, they also have it. Like they still keep a leg in the industry. So like for me personally, I still manage a quant fund outside of my SMU duty. So I have I'm doing a portfolio manager job, and I'm also like owning the fund, and that makes the project we design significantly better than someone who is purely having a pure academic background. When they try to design any project at the professional master degree level, it tends to be too academic and also too theoretical. It doesn't really showcase the constraint that we will face within the finance industry. So I think one example that I could give is that this term, for example, our students who are doing stochastics with me, they are actually given a data that is actually like 5 gigabytes in size, and that gives them just 10 days worth of option data. But those 10 days were the first 10 days in April, April the 1st to April the 10th this year, which most of us know that it was the liberation tariff announcement date. And there are many things interesting happening in the market in that day. It's not just Trump making an announcement. So yes, he made an announcement, the market tanked immediately, but it happens before market opens, right? And then after that, when China responds, when other countries start to respond, they also announce it in their out of the market hours. So every economy try to announce these bad news in out of their regular trading hours. And the data I provided for the students is that it is a tick by tick 24 hours data. So they get the full database of everything. And then they are just asked to see what sort of conclusion can you extract from this data, right? So it involves coding, it involves data processing, it also involves modeling, stochastic modeling to help them understand the interplay between the underlying stock market and the option market. And they are able to come back with many interesting observations that I haven't thought of. When I look at their work, we have discussions, and then they are able to discover something new, and we discuss this research outcome together. I think that is our unique selling point, in that if you have practice oriented instructor in the faculty list, the students can really benefit significantly more out of it.
Got it. Professor, our next question is like common question across the board. Understanding that there's a good amount of influence of AIs and machine learning in every aspect of career that we are currently pursuing. Can you help us understand what are the upcoming career prospects that are available for the students that are pursuing, education or degree programs around investment, quantitative analysis, etc. And how are they influenced by AI, and what is the up and coming career prospects that the students should look forward to?
I see. Yeah, I think that's also a good question. I think there are admittedly a lot of fear mongering among many people at the moment who are saying that, I'm going to stop hiring real human, and all the jobs that can be replaced by AI, there'll be no more human involved. But I think that is really not the best way to look at things, right? I think AI is just a tool, right? It's not creative. It can't just regurgitate patterns that you have fed to it. If you feed it the whole internet data available, then it essentially gives it all the knowledge. We can just think of it as now we have an additional layer of abstraction on top of all the knowledge database that human have possession of. Maybe last century, we have to go up to a library to look for the data. And when we are World Wide Web, we can search for it easier. And now we can rearrange and pivot data in the way that is significantly more efficient. That is such a great thing for all of us. It helps me tremendously in my own research, right? I find that if I need to do research, I need to look for some background idea. It's so much easier for me to learn things and pick up skills a lot quicker. So I think for us, right, for all the students who are considering doing a master degree, right, you are at the level where you are dealing with knowledge and doing intellectual pursuit on a day-to-day basis. AI must become part of your tool that you use every day, right? Try to integrate AI into your daily workflow, right? No matter how, just start using it and try to see where can you slot it into your daily workflow to make your work a bit more efficient. Because eventually, I'm sure that the person who is going to be replaced is not going to be AI replacing one person, but rather those people who know how to use AI in the most efficient way will then be able to replace everyone else who is not actually AI savvy enough to know how to use it to improve their work. So still, eventually, the human factor is still going to be there. And if you are up to speed with AI, it is also significantly easier for you to spot, right? What is the thing that is going to be at risk? If AI can write, maybe one example I can give also from my personal experience, for those of us for whom English isn't a first language, right? When we write research paper, we often need to engage a copy editor who are not doing the research, but they will write maybe in our semi-broken English into a paper, and then they will help us polish the language, they'll help us do copy editing, and they'll do all of these to package the phrasing into a more presentable form. That is actually now replaceable by AI. I think that is actually is in along the way, and you notice that now rephrasing sentences is actually not a important skills to have in the future. Maybe spend more time doing your research and no need to spend so much time worrying about your grammar errors and so on. So I think as long as you are always on the, you're always following the trend and knowing what is the latest happening, you are going to be a lot more wary and savvy about what is the next fashion, what is the most fashionable thing, and how to use it in the best way possible.
Perfect. Thank you, Professor. Our last question is to you, Lynn. If you had to give an advice to students that are applying for this current intake, in terms of what kind of attitude to maintain, what are the kind of deadlines that they should keep in mind, do you have any advice for these students?
Yeah, of course. So for those of you who are considering taking a master's, I would really encourage you to research on the programs that you are applying for, and also be mindful what kind of career outcome it can provide you, because you need to understand the skill set that you need to hone in order to achieve the career that you want. So it comes hand in hand. It doesn't mean like, okay, so quantitative finance is the next big thing. That's why I'm applying for it. It really also matters if you are interested in things like programming, mathematics, calculation, and things like that. So if you are going to apply for a program, be serious about it, understand what benefits it can bring to you, and prepare accordingly to the admissions requirements. Before the interview that we are going to give, if you happen to go into the interview, be serious about your interview, practice your interview if you're not confident, and understand what you're going to share to the interviewer. I think all this preparation really shows when you present yourself, right? Be it to the interviewer or be it to your classmates if you are accepted. It'll really translate into practical outcome when you graduate. I think that's about it. And the other part about the application deadline, our closing for the August 2026 intake will be on 31st of May. So you have plenty of time to do your research, but do apply early because we do have rolling admissions, meaning to say if you apply early, you have better pool of scholarship that you can apply to, and also you have less competition in terms of the class.
Got it. Thank you, Lynn, for this insightful session and walking us through all the details around admission and application process at SMU. A big thank you to Professor Wen as well for sharing such valuable insights in terms of the changing world of investment. I'd also like to thank attendees for joining today's session and for your active participation. On behalf of SMU and Seed Global Education, I thank you for being part of this session and for putting up your questions to our speakers. If you have any questions or any more concerns around SMU programs, etc., around scholarships, etc., you can write to us, the Seed Global Education team, either through our social media platforms or through info@seedglobaleducation.com. We will make sure that your concerns are answered. We will either direct it to our speakers or get in another expert from the university to get your concerns resolved. If you need any assistance in terms of identifying scholarships, options, etc., you can check out the Seed scholarship page for more information as well. Stay tuned for more upcoming masterclasses that are conducted by leading universities, and for any other sort of updates in the global study abroad education world, do stay connected with us on social media. Thanks a lot on behalf of Seed Global Education and SMU. I thank you all. Have a wonderful, wonderful, wonderful day or evening ahead.
Thanks,
Thank you, everyone. Thank you for having us.